Most of us will be pretty familiar with the term fund when it comes to investing, but there are several different types and they come in many shapes and sizes. One version that's often overlooked is the investment trust. They have certain characteristics which mean they're quite different from open-ended pooled investment funds. And I'd like to explain how you can assess an investment trust and whether it may be suitable for inclusion in your personal portfolio once you've done your own research. Hello, I'm Russ Mould, AJ Bell's Investment Director, and in the next few minutes I'm going to take you through a 10-point checklist that should help you in your personal study of whether an investment trust is right for you or not. So, check number 1 is the mandate of the investment trust. This means, will the trust invest in an asset class that is suitable for you? They can invest across a huge range of options, from shares to bonds to property, from quoted companies to private ones, and across a wide range of geographies and industries, from Japan to Latin America to the UK, technology to mining. The choice is yours, but you need to make sure it fits with your personal target returns, time horizon, and appetite for risk. Remember, by appetite for risk, I mean the willingness and ability to suffer losses in the pursuit of gains. Check number 2 is the style of the investment trust. Some target income through the steady harvesting of dividends from shares and coupons from bonds. Some target capital growth by trying to pick securities or assets which will rise in value over time. Some try to provide a mix of both. You will know which style you personally prefer. Check number 3 is the identity of the fund provider. You may feel more comfortable buying trusts provided by a big fund manager whose name you know and trust, who offers a wide range of choice and who provides research tools and clearly presented investor updates on its website. Check number 4 is the performance record of the individual fund manager and the individual investment trust itself. Now, we all know the past is no guarantee for the future, but in the end you are looking for the investment trust to protect and boost your wealth, so you're bound to check out how the fund manager and the trust have done over time. Ideally, you should study 5 or even 10 years of data if the trust has been around that long, and the same goes for the fund manager. You'll be looking for absolute performance, not just performance relative to a benchmark. You can also look at third-party research, such as the Morningstar ratings made available on the AJ Bell You Invest website. The good news is all of the performance figures and star ratings are available for free from a range of sources, including the fund manager themselves and also your broker. Check number 5, well, that's the cost of owning the investment trust. Investment trusts are treated the same as shares, so you will pay the same costs for dealing and holding the trust as you would for a share. Additionally, there will be an ongoing charge figure or OCF each year taken by the investment trust manager. Now, the good news for you here is that competition and pressure from regulators and your fellow investors means that these costs are trending down. They've fallen by around 20 basis points or 1/5 of a percentage point over the past few years, and if I was forced to guess, I'd say that the average OCF will drop below 1% before too long, excluding or perhaps even including performance fees. It's easy to compare OCFs and performance when looking at investment trusts that target the same asset classes, geographies and industries, or even different ones via a number of free websites. Check number 6 is the process followed by the trust and the resource available to its fund managers. Ideally, you're looking for a well-resourced investment trust with a number of managers working on the portfolio, although not so many that the costs balloon, with good support from in-house research that may give them a performance edge. In addition, you should try to understand what the fund managers look for, how they work, and the process they use. Do they do lots of company meetings? How long do they hold an investment for, on average? What are their preferred valuation tools? Do they hold their securities passively or do they actively engage with management teams? You'll know what you are looking for here. Check number 7 is where we start to get a bit more technical, as you need to look at the discount to net asset value, or NAV. Remember that with an investment trust you are buying shares in the portfolio, and the shares can trade at a discount or a premium to the underlying value of the holdings. The shares will respond to supply and demand, more sellers than buyers or more buyers than sellers. It's generally best to avoid paying a premium if you can, as this is effectively giving away some of your future performance, and a discount can be a nice way of getting in. Discounts can exist if the investment trust sector is out of favour or performance has hit a bit of a rocky patch. If sentiment turns, the underlying assets may go up and the discount close, adding to your investment return. Equally, well, the reverse can happen and the discount can widen and the underlying holdings fall in value. The average discount to NAV across the Association of Investment Companies went as high as 17 to 18% during the Great Financial Crisis and market meltdown of 2008, but it's gone down to very low single-digit percentage levels when asset prices have been rising strongly and confidence was high. And again, some individual trusts have actually traded at a premium to NAV, in some cases for a long time, if the manager has a good performance record and his or her specialty of style are in favour. Now, check number 8 is to look at the investment trust's dividend policy. Not all of you will be looking for income, but those who are may be intrigued to learn that 19 investment trusts have increased their dividend every year for at least 20 years, and 18 more have done so for at least the last decade. In addition, 43% of Association of Investment Company members pay quarterly dividends, up from 17% in 2010. There's a few who even make monthly payments. Check number 9 is another technical one, namely to look at the investment trust's gearing, and you can do this by looking at the fact sheet or research that's available freely on websites such as ours. Investment companies can borrow, gear up, to magnify income and capital returns, though it can also have the opposite effect and magnify losses, so only you will know whether you're comfortable with this or not. The average gearing ratio across the industry has tended to hover in the mid-single-digit percentage range, according to the Association of Investment Companies, although there is quite a wide range between individual investment trusts, from 0 in some cases to 20, 30, 40% or more at others. And last, but by no means least, check number 10 is to look at the composition of the board. Those executives are there to monitor performance and also ensure that shareholders and stakeholders' interests are aligned. If they think circumstances require it and performance has been sufficiently poor, the board can actually sack a fund manager or change the mandate of the trust. You should therefore check to make sure the board members have suitable skills and the right experience for the job. Ideally, the board should also own some shares so they have the same vested interest as you when it comes to how the investment trust performs. So, just to summarise, my suggestions for a 10-point checklist on how to select an investment trust that may be right for your personal needs and investment goals is as follows. Number 1, mandate. Number 2, style. Number 3, fund provider. Number 4, performance record. Number 5, fees. Number 6, process and resource. Number 7, discount to NAV. Number 8, dividend policy. Number 9, gearing. And 10, board composition. This list is by no means exhaustive, but it is hopefully manageable and a useful pointer when it comes to doing the research you simply have to do before you invest and look for the best risk-adjusted returns which suit your personal investment strategy and goals, time horizon and appetite for risk. Now, if you're a bit pressed for time or simply want to narrow down your options from the hundreds of investment trusts on our website, then why not take a look at the Investment Trust Select list. Using the criteria I just mentioned, our experienced in-house team has rigorously researched the investment trust market and drawn up a list of favourites for you to choose from. Just remember, our list isn't a personal recommendation, and as mentioned, it's important that you do your own research before deciding to invest. Thank you for watching, and I look forward to seeing you next time.